Tax avoidance is the legal usage of the tax regime to one's own advantage, to reduce the amount of tax that is payable by means that are within the law. Tax sheltering is very similar, and tax havens are jurisdictions which facilitate reduced taxes. The term tax mitigation is sometimes used. Its original use was by tax advisors as an alternative to the pejorative term tax evasion. Tax-aggressive strategies fall into the gray area between commonplace and well-accepted tax avoidance and evasion. However, the uses of these terms vary. Laws known as a General Anti-Avoidance Rule statutes which prohibit tax-aggressive avoidance have been passed in several developed countries including the United States, Canada, Australia, New Zealand, South Africa, Norway and Hong Kong. In addition, judicial doctrines have accomplished the similar purpose, notably in the United States through the business purpose, and economic substance doctrines established in Gregory v. Helvering and in the UK through the Ramsay case. Though the specifics may vary according to jurisdiction, these rules invalidate tax avoidance which is technically legal but not for a business purpose or in violation of the spirit of the tax code. Related terms for tax avoidance include tax planning and tax sheltering. The term avoidance has also been used in the tax regulations, examples and source needed of some jurisdictions to distinguish tax avoidance foreseen by the legislators from tax avoidance which exploits loopholes in the law such as like-kind exchanges. The United States Supreme Court has stated that the legal right of an individual to decrease the amount of what would otherwise be his taxes or altogether avoid them, by means which the law permits, cannot be doubted. Tax evasion, on the other hand, is the general term for efforts by individuals, corporations, trusts and other entities to evade taxes by illegal means. Both tax avoidance and evasion can be viewed as forms of tax non-compliance, as they describe a range of activities that are unfavorable to a state's tax system. Methods: country of residence. A company may choose to avoid taxes by establishing their company or subsidiaries in an offshore jurisdiction. Individuals may also avoid tax by moving their tax residence to a tax haven, such as Monaco, or by becoming a perpetual traveler. They may also reduce their tax by moving to a country with lower tax rates. However, a small number of countries tax their citizens on their worldwide income regardless of where they reside. As of 2012, only the United States and Eritrea have such a practice, whilst Finland, France, Hungary, Italy and Spain apply it in limited circumstances. In cases such as the U.S., taxation cannot be avoided by simply transferring assets or moving abroad. The United States is unlike almost all other countries in that its citizens and permanent residents are subject to U.S. federal income tax on their worldwide income even if they reside temporarily or permanently outside the United States. U.S. citizens therefore cannot avoid U.S. taxes simply by emigrating from the U.S. According to Forbes magazine, some citizens choose to give up their United States citizenship rather than be subject to the U.S. tax system. However, U.S. citizens who reside outside the U.S. may be able to exclude some salaried income earned overseas from income in computing the U.S. federal income tax. The 2012 limit on the amount that can be excluded is $95,100. Double taxation. Most countries impose taxes on income earned or gains realized within that country regardless of the country of residence of the person or firm. Most countries have entered into bilateral double taxation treaties with many other countries to avoid taxing non-residents to say once where the income is earned and again in the country of residency. However, there are relatively few double taxation treaties with countries regarded as tax havens. To avoid tax, it is usually not enough to simply move one's assets to a tax haven. One must also personally move to a tax haven to avoid tax. Legal entities. Without changing country of residence, personal taxation may be legally avoided by the creation of a separate legal entity to which one's property is donated. The separate legal entity is often a company, trust, or foundation. These may also be located offshore, such as in the case of many private foundations. Assets are transferred to the new company or trust so that gains may be realized, or income earned, within this legal entity rather than earned by the original owner. If assets are later transferred back to an individual, then capital gains taxes would apply on all profits. Also, income tax would still be due on any salary or dividend drawn from the legal entity. For a settlor to avoid tax, there may be restrictions on the type, purpose and beneficiaries of the trust. For example, the settlor of the trust may not be allowed to be a trustee or even a beneficiary and may thus lose control of the assets transferred and/or may be unable to benefit from them. Legal vagueness. Tax results depend on definitions of legal terms which are usually vague. For example, vagueness of the distinction between business expenses and personal expenses is of much concern for taxpayers and tax authorities. More generally, any term of tax law has a vague penumbra, and is a potential source of tax avoidance. Tax shelters. Tax shelters are investments that allow, and purport to allow, a reduction in one's income tax liability. Although things such as home ownership, pension plans, and individual retirement accounts can be broadly considered tax shelters, insofar as funds in them are not taxed, provided that they are held within the individual retirement account for the required amount of time. The term tax shelter was originally used to describe primarily certain investments made in the form of limited partnerships, some of which were deemed by the U.S. Internal Revenue Service to be abusive. The Internal Revenue Service and the United States Department of Justice have recently teamed up to crack down on abusive tax shelters. In 2003, the Senate's Permanent Subcommittee on Investigations held hearings about tax shelters, which are entitled U.S. Tax Shelter Industry, the Role of Accountants, Lawyers, and Financial Professionals. Many of these tax shelters were designed and provided by accountants at the large American accounting firms. Examples of U.S. tax shelters include Foreign Leveraged Investment Program and Offshore Portfolio Investment Strategy. Both were devised by partners at the accounting firm, KPMG. These tax shelters were also known as basis shifts, or defective redemptions. Prior to 1987, passive investors in certain limited partnerships were allowed to use the passive losses of the partnership to offset the investor's income, lowering the amount of income tax that otherwise would be owed by the investor. These partnerships could be structured so that an investor in a high tax bracket could obtain a net economic benefit from partnership-generated passive losses. In the Tax Reform Act of 1986, the U.S. Congress introduced the limitation on the deduction of passive losses and the use of passive activity tax credits. The 1986 Act also changed the at-risk loss rules of 26 U.S.C. A.A. millisecond 465. Coupled with the hobby loss rules, the changes greatly reduced tax avoidance by taxpayers engaged in activities only to generate deductible losses. Transfer mispsing. Fraudulent transfer pricing, sometimes called transfer mispsing, also known as transfer pricing manipulation, refers to trade between related parties at prices meant to manipulate markets or to deceive tax authorities. For example, if Company A, a food grower in Africa, processes its produce through 3 subsidiaries, X, Y and Z. Now, Company X sells its product to Company Y at an artificially low price, resulting in a low profit and a low tax for Company X based in Africa. Company Y then sells the product to Company Z at an artificially high price, almost as high as the retail price at which Company Z would sell the final product in the U.S. Company Z, as a result, would report a low profit and, therefore, a low tax. About 60% of capital flight from Africa is from improper transfer pricing. Such capital flight from the developing world is estimated at 10 times the size of aid it receives and twice the debt service it pays. The African Union reports estimates that about 30% of sub-Saharan Africa's GDP has been moved to tax havens. Solutions include corporate or a country-by-country reporting where corporations disclose activities in each country and thereby prohibit the use of tax havens where real economic activity occurs. Tax avoiders, United Kingdom. One historic example of tax avoidance still evident today was the payment of window tax. It was introduced in England and Wales in 1696 with the aim of imposing tax on the relative prosperity of individuals without the controversy of introducing an income tax. The bigger the house, the more windows it was likely to have, and the more tax the occupants would pay. Nevertheless, the tax was unpopular, because it was seen by some as a tax on light, and led property owners to block up windows to avoid it. The tax was repealed in 1851. Other historic examples of tax avoidance were the deliberate destructions of roofs after World War II in order to avoid substantial property taxes. The owners of buildings, like Fetteresso Castle and Slains Castle in Scotland, deliberately destroyed their roofs in protest at the new taxes. In 2011, ActionAid reported that 25% of the FTSE 100 companies avoided taxation by locating their subsidiaries in tax havens. This increased to 98% when using the stricter U.S. Congress definition of tax haven and bank secrecy jurisdictions. The 2013 United Kingdom budget was for lack of measures limiting transactions seen as the cause of tax avoidance, such as the use of intellectual property holding companies outside the UK where there is no commercial substance to support the transaction. Instead, the UK government chose to rely on the OECD-led initiative on base erosion and profit shifting. United States, an IRS report indicates that, in 2009, 1,470 individuals earning more than $1 million annually faced a net tax liability of 0 or less. Also, in 1998 alone, a total of 94 corporations faced a net liability of less than half the full 35% corporate tax rate, and the corporations Lyondell Chemical, Texaco, Chevron, CSX, Tosco, PepsiCo, Owens & Minor, Pfizer, JP Morgan, Saks, Goodyear, Ryder, Enron, Colgate-Palmolive, WorldCom, Eaton, Weyerhaeuser, General Motors, El Paso Energy, West Point Stevens, MED Partners, Phillips Petroleum, McKesson and Northrop Grumman all had net negative tax liabilities. Additionally, this phenomenon was widely documented regarding General Electric in early 2011. Furthermore, a Government Accountability Office study found that, from 1998 to 2005, 55% of United States companies paid no federal income taxes during at least 1 year in a 7-year period it studied. A review in 2011 by Citizens for Tax Justice in the Institute on Taxation and Economic Policy of companies in the Fortune 500 profitable every year from 2008 through 2010 stated these companies paid an average tax rate of 18.5% and that 30 of these companies actually had a negative income tax due. In 2012, Hewlett-Packard lost a lawsuit with the IRS over a foreign tax credit generator, which was engineered by a division of AIG. As a result of the tax sheltering, the government responded with Treasury and Treasury Department Circular 230. In 2010, the Healthcare and Education Reconciliation Act of 2010 codified the economic substance rule of Gregory v. Helvering. Public opinion: tax avoidance may be considered to be the dodging of one's duties to society, or alternatively the right of every citizen to structure one's affairs in a manner allowed by law, to pay no more tax than what is required. Attitudes vary from approval through neutrality to outright hostility. Attitudes may vary depending on the steps taken in the avoidance scheme, or the perceived unfairness of the tax being avoided. In 2008, the charity Christian Aid published a report, Death and Taxes: The True Toll of Tax Dodging, which criticized tax exiles and tax avoidance by some of the world's largest companies, linking tax evasion to the deaths of millions of children in developing countries. However, the research behind these calculations has been questioned in a 2009 paper prepared for the UK Department for International Development. According to the Financial Times, there is a growing trend for charities to prioritise tax avoidance as a key campaigning issue, with policymakers across the world considering changes to make tax avoidance more difficult. In 2010, tax avoidance became a hot-button issue in the UK. An organisation, UK Uncut, began to encourage people to protest at local high street shops that were thought to be avoiding tax, such as Vodafone, Topshop and the Arcadia Group. In 2012, during the Occupy movement, tax avoidance was proposed as a tool of U.S. government protest by the organisation Tax Killer. Prem Sikka, professor of accounting at the Essex Business School and scientific advisor of the Tax Justice Network, pointed to a discrepancy between the corporate social responsibility claims of multinational companies and their internal dynamics aimed at maximizing their profits through things like tax avoidance. He wrote in an article commenting the LuxLeaks publications, big corporations and accountancy firms are engaged in organized hypocrisy. Government and judicial response. Tax avoidance reduces government revenue, so governments with a stricter anti-avoidance stance seek to prevent tax avoidance or keep it within limits. The obvious way to do this is to frame tax rules so that there is a smaller scope for avoidance. In practice, this has not always been achievable and has led to an ongoing battle between governments amending legislation and tax advisors finding new scope loopholes for tax avoidance in the amended rules. To allow prompter response to tax avoidance schemes, the U.S. tax disclosure regulations require prompter and fuller disclosure than previously required, a tactic which was applied in the UK in 2004. Some countries such as Canada, Australia, United Kingdom and New Zealand have introduced a statutory General Anti-Avoidance Rule. Canada also uses foreign accrual property income rules to obviate certain types of tax avoidance. In the United Kingdom, many provisions of the tax legislation apply to prevent tax avoidance where the main object, or one of the main objects, of a transaction is to enable tax advantages to be obtained. In the United States, the Internal Revenue Service distinguishes some schemes as abusive, and therefore illegal. The alternative minimum tax was developed to reduce the impact of certain tax avoidance schemes. In the UK, judicial doctrines to prevent tax avoidance began in IRC v Ramsay, followed by Finis v Dawson. This approach has been rejected in most Commonwealth jurisdictions, even in those where UK cases are generally regarded as persuasive. After 2 decades, there have been numerous decisions, with inconsistent approaches, and both the revenue authorities and professional advisors remain quite unable to predict outcomes. For this reason, this approach can be seen as a failure or at best only partly successful. In the judiciary, different judges have taken different attitudes. As a generalization, for example, judges in the United Kingdom before the 1970s regarded tax avoidance with neutrality. But nowadays they may regard aggressive tax avoidance with increasing hostility. In the UK in 2004, the Labour government announced that it would use retrospective legislation to counteract some tax avoidance schemes, and it has subsequently done so on a few occasions, notably BN 66. Initiatives announced in 2010 suggest an increasing willingness on the part of HMRC to use retrospective action to counter avoidance schemes, even when no warning has been given. See also, Gregory v. Helvering, General, Base Erosion and Profit Shifting, Capital Flight, Gaming the System, List of foundations established in VADs, Tax Evasion, Tax Non-Compliance, Luxembourg Leaks, References. External links, Tax Avoidance Collected News and Commentary at The Guardian, Fact File, Tax Avoidance, The Independent.